So today we are going to talk about tax strategies. My name is Ravi Khan, and I am the Chief Imagineer of Imagine Co-working, as well as Managing Partner of Creative Financial Partners and Creative Tax and Business. So that does make me a resident expert on this subject matter. And I'm excited. This is probably one of my favorite topics to discuss is taxes. And I think that's probably unique compared to most people that I talk to that want to run as far and as fast away from taxes as they possibly can. But the reason that I love talking about this subject is that it's a game. And the more that you can play the game, the more you understand the rules of the game, I should say, the more you can win at this game. And so a couple things that we're going to talk about today. And again, just to build on that, we're going to talk about what type of entity you may currently have for your business. We're going to talk about options for entity structure and what types of things might you be able to do even before the end of the year or leading into next year around that. We're going to talk about the difference between deductions and credits and what that means and what are some of the most prevalent ones that people overlook or miss. We're going to talk about year-end tax planning strategies. So a combination of things from moving income around to how much AR and accounts payable, accounts receivable is AR, accounts payable, AP, how much of that you might choose to work through before the end of the year. And then we're going to talk about how you can leverage all of these things on a go-forward basis, really around strategic planning. So our last few workshops have talked about the need to have a business plan, a marketing plan. Going back to tax planning, you'll start to realize that there's a theme to these workshops that we're hosting, and they center around the need to plan. It's not just about making decisions. It's about having a plan and executing that plan. Taxes are really no different. If you have a good business plan and you have some sense of where you've been, where you are, and where you're going, then you can make really informed decisions when it comes to what types of tax strategies you want to leverage so that you best take advantage of paying as little as possible in taxes, or better yet, over time paying as little as possible in taxes, which again comes back to having a plan. And the best way I can explain that to folks is there may be situations where this particular year, 2024, that we're in is an anomaly, a down income year for whatever reason related to your business. It might also be a really big year related to your business. And you need to be able to understand where were you last year in 2023? Where do you project to be in 2025, 2026 to make certain decisions about how much you might want to pay in 2024? So there are two things. So the saying goes, there are two things that are certain in life, death and taxes. And while I will say those are very likely the case, we have a lot of influence over how much we pay, or even how long we live, based on how we operate and how we act in the present day, right? So the healthier we live, the better job we do of exercising, eating, living a frugal, prudent lifestyle, then the longer we live. With taxes, same idea. The more savvy we are, the more we understand the rules of the game, the better we're going to be able to, over time, reduce our overall tax burden. What does that really mean to you? So what's the importance of this instead of just saying, I don't want to pay in taxes? I hear that all the time. My question usually is more from a humorous standpoint. Why don't you want to pay in taxes? Do you benefit from any of the things that taxes actually do for you? And the answer is often yes. Most people have different services that they benefit from that taxes help support. That said, you may not like how your tax dollars are spent and therefore want to be in control of how much you pay into the system. The other side of that coin, though, is it's really a question about what kinds of taxes do I want to pay? Do I want to pay income tax? Do I want to pay property tax? Do I want to pay sales tax? Do I want to have a choice over the types of taxes that you pay? And that, again, is something that you have total control over based on strategies that you choose to implement. Depending on where you live, what the value of your property is going to dictate in part what your real estate taxes are. Depending on what you do with your business is going to dictate how much income tax you pay and whether that tax is paid by your business or by you as an individual. So we have a lot of things that we get to control, and this is really what this workshop is going to look to delve into is how do you maintain control over the amount of taxes you pay, when you pay it, and who is ultimately responsible for that liability, be it you, be it your spouse, be it your kids, be it your business, etc. So that's our objective here with these workshops. Jumping right in, what's the importance of tax planning? But what is the value of tax planning? So I want to give you some statistics that we're able to decipher online around benefits and things that I've personally experienced and seen working with clients for the last 24 years on their taxes fall into actuality for individuals and business owners when they have proactive tax strategies. So number one is you're going to save substantially on your tax on how much you pay year over year. And so this has between 20 and 30% of your taxable income. I've seen considerably more in certain calendar years. I've seen less. That's gonna be a unique factor for your situation. And again, part of it may be that we don't want to pay less in tax this year because we want to prepare ourselves and set ourselves up to pay less next year or the year after when income and profit might actually be even better than it is today. So we make a conscious choice to pay more in tax this year, but to save 40 and 50% in future years. So those are the types of things that, again, planning is really going to help us with. Nearly 90% of taxpayers miss out on potential benefits. That is 100% accurate. So I can tell you that almost without a doubt, I would say it's closer to 100%, maybe 98% of people are missing out on something that they could do to lower their tax liability, again, over the longevity of their lifetime. So maybe it's not this year because consciously we want to reduce it for next year, or we had reduced it last year. But hands down, people are missing out on opportunities because they're just uninformed. So think about that for a second. Is most people have played the game Monopoly. If you didn't know how to play the game, would it be very challenging? And do you think you might lose more quickly than if you understood the rules of how it works? If you didn't understand, you collect $200 every time you pass go, do you think you're going to be at a disadvantage compared to the other players that understand that concept? I think we'd all agree yes. The same thing is true with taxes. It's just that people, one, don't spend the time and energy to try to understand their situation and how taxes impact them personally. Not that you have to go out and become a tax expert, but you do need to understand how taxes impact you personally and your business. And number two is it's complicated. So let's face it, the rules of taxes is way more complicated than the rules of Monopoly, and there's a lot of them. So how do you figure all that stuff out? Well, one, I suggest everybody should want to spend some more energy and time than they presently do to become a student of the business, meaning become a student of how taxes work and what some of the basic concepts are. But two, find somebody that you trust that can help you. And I don't care if that's Wikipedia, if that's turbotax.com, if that's a trusted accountant, CPA, a business professional, but find somebody who can be a sounding board or a resource to either help you prepare it, or most importantly, to help give you advice so that you can proactively be making decisions throughout the entire year and throughout multiple years in advance for how you can reduce your tax liability over time. And you have to make this a priority. If you don't, you're literally just wasting money. You might as well throw money into the fire. It's cold here. I'm in Atlanta. It's really cold these days. So if you're making a fire, you might as well just literally pull out your wallet and throw cash in there. It's the same as overpaying your tax liability. And it's as simple as solving that problem. It's some of the resources I just described to you. Become a student of how it works. Find resources to help you. Understanding things like Section 179 and credits like the work opportunity tax credit. So we're going to get into a little bit more detail, the difference between deductions and the difference between credits, how they work, what are some of the most common ones. Businesses can save substantially. We've already talked about around tax planning, but it's really about a combination of not just reducing taxable income, because that may have its own ramifications. Oftentimes people will lower their taxable income and now it puts them at a disadvantage for how much they can contribute for retirement accounts. So again, the key to this is looking at things holistically of what's the cumulative amount you're going to pay in tax, even if we just take the next 5 years. And if we can reduce what the tax burden is over the next 5 years through strategy, sometimes it's pay yourself more. So it's not reduce your taxable income, it's pay an increased W-2 if you're an S Corp. And that allows you the potential that you might be able to fund more to a retirement account. So we have to look at how all the taxes come together and all the strategies come together and come up with the right combination of those, which is going to be unique for you, the right combination of those to put your tax puzzle back together. Also, tax planning allows you to be compliant. I got to tell you that I've, over 24 years, seen a lot of people that ultimately may or may not ever be caught. But if they do, they have really no recourse when they go to the IRS and sit down to explain where numbers come from. And unfortunately, there's a lot of unscrupulous people out there willing to put made up numbers on tax documents, either on your behalf or they make them up for you and they'll put them down to reduce your tax liability. Why does that happen? I think of that sort of the idea of integrity. If you're in a situation where your integrity is challenged, how did you get in that situation? Now, hopefully you have enough integrity to still follow through and not have to lie and make things up. But the question becomes, why did you put yourself in a situation where you got to a place where you owe so much at the end of the year, you had to jeopardize your integrity in order to be able to reduce that tax liability? You didn't plan. That's really what it comes down to. So often people are shocked, surprised, whatever word you want to use. And it's painful when you find out you got a 30, 40, 50, $100,000 tax bill on April 1st. That's really uncomfortable. But if you knew that there was going to be a tax liability because you're having an unbelievable year and you knew that in February of the prior year, you could make decisions throughout the entirety of the year, or you could save money and not spend it all so that you're prepared when that time comes that you owe that tax liability. And ideally, you've reduced your tax liability along the way. What are some things that sole proprietors can do? Let's talk about entity selection and how that works. So understanding your current tax position, and this really, I'm going to talk about entity selection with regards to that. So there are reasons why that's smart and you would want to be a C corporation. For most small businesses, that is not going to be the most advantageous route, however, which means if you file as an Inc. or a corp with your Secretary of State, and then you don't do anything else, the IRS is waiting for you to file a C corporation tax return. Instead, if you are choosing to become an S corp, which is more of a pass-through income situation, meaning what my business profits, I then take that profit and move it to my personal return, and that's where the tax liability will exist on my personal return, then you are required to file paperwork with the IRS. And what that means is you're going to include on your Schedule C, you'll have a schedule as part of your personal tax return where all your business details will reside. You're going to have your income, the revenue you brought in. You're going to have any cost of goods. That's basically the value of things that it took to produce your revenue. And then you're going to have all of your business expenses. So cell phones, internet, car allowances, meals and entertainment, professional services, any number of things that are your expenses that you'll now take underneath your business. If you are just a sole proprietor, and this could exist because you've done nothing to set up any kind of an entity with the Secretary of State or the IRS, or if you go and you set up an LLC, then you are by default a sole member LLC, which means you're taxed the same as a sole proprietor. Okay. And so what are some drawbacks of being a sole proprietor? The first one is going to be that all the profit that you make, let's just say for an example, I make $100,000 this year. I take expenses of $40,000. I now have a profit of 60. All of that profit, I have to pay federal tax, state tax, if you live in a state where you have state taxes. Then I also have to pay Social Security and Medicare, both as an employee and employer. So essentially, I'm paying double the Social Security and Medicare tax as a self-employed or a sole member LLC. That can get pricey. Think about it. If I'm in a 30+% federal tax bracket, in Georgia, our state tax is somewhere between 5.5%, 6%, around that range, 5 to 6%. Let's call that 5 for simple math. So if I'm at 30% federal, 5% state, and now Social Security and Medicare as both employee and employer, which is 15.3%, my total taxes are north of 50%. So I got to pay tax over 50% on the profit that I made from my business. Starting to feel like a socialist society when you got to pay 50, 60% in taxes, I would say. So that's expensive, but that's what it is if you're just a sole proprietor or you have an LLC and you're a sole member LLC because, again, you file as a sole proprietor. What are some options to reduce some of that liability? One might be, is a C corporation make more sense? Does it make sense to pay tax at the corporate level, which is typically at a lower rate than the personal level? Most corporate taxes today are going to be somewhere between a 15 to 25% range with some of the add-on taxation that they have. So that could very well be lower than your personal taxes. And depending on how much you take out of the business, it might work out that it is cheaper to be a C Corp. For most people, an S Corp, once you start getting your income above a certain threshold, or your profit, I should say, above 25, 30,000, an S Corp very likely is going to be a viable option for you. Now, as an S Corp, what happens is you are required to take a reasonable salary out of your S Corp. So as an owner of an S Corp, which can be one or multiple owners, you are required to take a reasonable salary. Now, often people say, what's a reasonable salary? Reasonable says, what would somebody, if you had to go hire somebody to do the functions that you do within your business, what would that cost look like? So let's say I own a plumbing company, and part of what I do is I go out and I'm a plumber. Then part of what I need to do is I need to be able to pay myself a salary for the plumbing work that I do. Now, I don't need to pay myself a salary for the oversight or the management or the ownership of the business. That's going to come in the form of distribution or dividends that I pay myself, okay, which I'm allowed to take out of the company. But I do have to pay a reasonable salary for the tasks that I perform that I would otherwise have to pay somebody else for those similar tasks. So let's say I'm a business consultant and I have an S Corp. Again, if I was hiring a consultant and I had to pay them, what would they cost? And how much of my work is spent doing that function versus doing a supervisory or an ownership function. And that's how we decide on how much income needs to be taken as a W-2 salary and how much needs to be taken as a distribution or dividend as essentially profit that the business is earning. So what's important about all that as an S Corp? The money that I take as a dividend or distribution, I do not have to pay Social Security and Medicare tax on. So if I, now in the same situation, let's just say I make $100,000, I have $40,000 of expenses, I make profit of 60 grand, and I take a $25,000 salary because that's the reasonable compensation I'd have to pay somebody else. On my $25,000 of W-2 salary, I will pay at a federal, state, if applicable, Social Security and Medicare, employee, employer, but on the $35,000 of distribution or dividend that I take, I will only have to pay federal and state taxes, no Social Security and dividends. Why does that matter? In my example, on the $35,000 that I take as dividends and distributions, I avoid a 15% tax, 15.3% tax. So that right there on that example that I just gave you is worth $5,300 in tax savings. So entity is important and relevant, and it's important to think about what are you today? Should that be different for this current year? For 2024, do you need to go back and try to file with an exception to change how you're going to be taxed for 2024? And two, do you need to think about where your business is going, and does it need to change in future years, 2025, 2026, 2027? Can we make proactive decisions for what type of an entity you should be then? The other thing that you want to think about is if you're a partnership, or you maybe are starting a business and you have a spouse. Do you want to be a minority-owned business? Do you want to be a woman-owned business? There are certain benefits of getting financing and funding, as well as certain projects where you get a better treatment if you are minority-owned, if you are a female-owned business. So there may be opportunities that you want to explore of who is actually the owner, and maybe you make the other person an employee of the business, or you make them a minority owner of the business. So you have to think about all these considerations when you think about the entity structure and how you set it up. Is not just purely taxes, but who are you going after? Who are you targeting? Who do you want to advertise to? Are there opportunities of funding that may be more appealing to you if you are structured in a certain way? All relevant of where you are and where you're going. The other thing that you want to take into consideration when you think about your entity strategy is going to be if you have partners. Often people will set up a business with partners, but they're not really true partners. Maybe you have somebody who financed your business. Maybe you have somebody who is they're a silent partner. Is a partnership the best method to be able to create that structure? It can be more expensive. There are also rules around taking mandatory compensation. So how you get money out of a partnership is you have to take guaranteed payments, which, just as I talked about earlier, as a sole proprietor, you have to pay federal, state, Social Security, and Medicare on those guaranteed payments as a majority partner. So there's a lot of considerations to how you set up your business and thinking about where your business is going in terms of entity structure. So very important to think about where you are, how you plan moving forward.